from an LP perspective and from just looking at the reality of the statistics, it's hard to get data. But if you just look at the IMF data, $19 trillion, half of everything you can buy in emerging markets. Check that statistic. Half of everything you can buy in emerging markets is Asian credit. It's a lot bigger than people think. You go look at the public multiples of companies listed in Asia, and you get roughly 3 to 4 times the average leverage ratio of Asian companies. They're growing fast. So $19 trillion of debt in Asia. Corporates borrow, sovereigns don't borrow, and that is actually a tremendous arena in which to operate. If you want 2% or you believe 5% of those projects that we talked about, that capital expenditure we talked about, is problematic, there's hundreds of billions of dollars in which to find companies that may not have done it perfectly. They may still be good businesses, but they may have gotten their capital expenditure on a particular project wrong. And our good problem is to put out $100, $200 million a quarter, and when you think about that on the scale of the region, there's actually quite a mismatch of the opportunity in credit relative to the number of investors that really are long-term thinkers about helping companies get back on their feet. So, it's actually the fundamental view that there is no distress in growth helps us keep our competitors out, but also give us a pretty interesting arena in which to play. One is valuation, and we think valuation is broachable, but you can't deny the fact that on a PE ratio basis that Asia is now, broadly speaking, parallel with the Western world, and that always faces valuation questions, because the great mistake that investors make over time is paying the wrong price for companies. It's not just about which company they do, but the price they pay for it. And so we worry about that fundamentally as value investors or downside investors. We worry about valuation. The good news is we find opportunities in sort of smaller and medium-sized enterprises today, and that there still are real valuation opportunities or companies going through difficulty, and that creates a valuation opportunity. The way we've tried to segment it and be confident of our knowledge in transactions is by doing 4 predominant sectors, and they're each very large. First, infrastructure. Second, renewable energy specifically, or energy broadly, but predominantly renewables. And third, in the property space. Fourth, we've actually looked at financial institutions. So each of those sectors themselves is quite large, and needless to say, when you think about capital expenditure, you generally think about debt, right? And so each of those is a heavy, capital expenditure category, with the exception of financials on its own. Infrastructure, property, and the renewables or the energy space, each of them has tremendous capex, and that's where we've put out over almost $500 million in China, and continue to find that quite a profitable arena for us, about 25% of our total capital at work.